Hey, Bulls and Bears, how is everyone doing? We're back. My name is JJ. You're watching Bull, Boom, Bear Bust, back with another dose of economic reality. Let's go ahead and get right into it. We have the testimony from Fed Chairman Jerome Powell in front of Congress. And I was disappointed. I did watch the entire thing. It was almost 3 hours. So I watched it so you wouldn't have to. Maybe you watched it anyways, but I watched the whole thing and I was kind of disappointed. We had people on the left and on the right, of course, in Congress questioning Jerome Powell about a lot of things, about the broader economy, about interest rate decisions, where rates are headed. Uh, and on one side of the political aisle, it was everybody cheering how great the economy is. And as you would expect, on the opposite side of the aisle were people basically criticizing the economy and holding Powell's feet to the fire a little bit. But on both sides, I didn't hear any questioning of the official numbers, right? So every number out there that we've debunked here that's flawed and manipulated and just wrong, nobody really called them out on that. I was very disappointed in that. I didn't really expect anyone to call them out on it, but we heard a lot. And Jerome Powell basically admitted that more banks are going to fail, which is, I think, overlooked. I don't think many people are even talking about that. But he did say that. We're going to get into that here in just a few minutes. But first, let's talk about this. More huge layoff announcements, and this is really going to underpin the strength, or I think non-strength, of the U.S. consumer. Take a look at this. Foot Locker, 30% plunge in their shares as they post holiday loss. Now, we know that the day after Thanksgiving, going all the way back to November, the day after the Thanksgiving is Black Friday. That's supposed to be the day where companies turn profit. So they go from being in the red as far as their bottom line and their balance sheet to profitable. Well, Foot Locker actually didn't see that. And it's pretty interesting to me because I rarely buy shoes online. And the big excuse for this, or the reason for this that some people put out there, will say, no, the economy is great. It's just everybody's shopping online. Well, I rarely buy shoes online because I like to try them on and walk around. Of course, a lot of people do buy shoes online, but it's interesting when you see this big of a miss in a share plunge by 30%. Foot Locker reported a holiday quarter loss on Wednesday as its shares plunged 30%. But it's not just that. Listen to this. The company also gave weak guidance for the current year and delayed a key profitability target. So when we look at that, we have to ask, the question, why is the narrative that the consumer is strong? And we see report after report after report. Almost every day we see these types of earnings misses or concerns and forward guidance that's not where it needs to be. So just that alone should be enough to let you know that something's going on with the economy that we're not being told for the most part. We kind of have to dig into the numbers and get into the data and get into the news in more depth and in more detail to figure it out. All right, now something else that's pretty big that's happened here is credit scores, consumer credit scores. Now remember, going back, we had a lot of changes implemented to basically designed to keep people's credit scores looking good and looking higher. That way the banks can justify continually loaning out more and more money, aka debt. And we saw the waiver of medical debt, or getting rid of that off of people's credit reports. We saw differences in scores and how they're rated. But here, take a look at this. Credit scores declined for the first time in a decade as more borrowers fall behind on payments. So here's possibly where the snowball begins. Up until now, we didn't see a big decrease in credit limits for people's credit card lines. Remember, back in the 2008 financial crisis, banks started dropping credit limits, aggressively dropping and lowering people's credit card ceilings, and therefore that had a broad impact on the economy. So not only did banks fail, you had this huge sudden drop off in consumer spending, and we know that consumer spending is one of the backbones, basically the driver of the economy, along with government spending and stimulus programs and money creation. But that's a big part of it. It's one of the backbones of the economy. And we had not seen this up until just recently, where credit card companies were increasing credit limits, increasing. without any concern for the amounts of debt, which are, what, 30% higher now than they were back in the financial crisis. You would think with debt being 30% higher than what it was in the financial crisis, that banks would start having maybe some sort of concern that consumers were getting too far in over their heads, too far underwater, so to speak. But, with the programs designed to keep the banks operational, even with this type of debt, we know that's the reason why banks weren't dropping limits. Well, what's going to happen now with these credit scores being dropped, first time in a decade? The national average credit score fell to 717, according to a new report out of FICO. Credit scores had steadily improved for a decade, but increases in missed borrower payments, what we talked about, defaults, delinquencies are increasing. And rising consumer debt levels are starting to take a toll. As of October, the credit card utilization was 35%, up from 33% the year earlier. And that's even with credit limits being increased by most of the credit card companies. Borrowers with a 30-day past due missed payment against their credit accounts was also higher. As we talked about here, defaults, delinquencies are increasing. How will the banks react? In order to keep the economy functional, they'll need to keep increasing credit limits. Otherwise, if you see a drop off in consumer spending, then you're going to see this economic downturn take a real fast, sudden drop. And of course, they don't want that to happen, especially here in 2024. So how will they react to this declining in credit scores? We already see a lot of consumers now, what we call the decline rate on automobile loans. It's about 50%. So half the people trying to get automobile loans now are being denied, and that's a sudden change, or I should say a recent change, because in 2023, for most of the year, we still saw banks willing to loan out all this money, even with car prices way higher than they should have been. And now with the decline rate being about 50%, we're starting to see the cost and the average price of automobiles come down, right? It's all about the lending. It's all about how much money can be put out there for people to buy things that they normally can't afford. And now we're starting to see the rubber hit the road on this. So could this be more price declines? Well, to me, it looks like that's going to happen unless they come out with new programs to help people stay in their vehicles and stay in their homes. We're likely going to see things get a lot worse and hopefully start to see some deflation in some of these areas, that we keep an eye on. All right, but back to what Jerome Powell was speaking about here, and I hadn't seen this reported very much. Take a look right here. Powell, there will be bank failures caused by commercial real estate losses. Now, what he said was that it's going to be mostly smaller and mid-sized banks, that it's not the mega banks, right? It's not the two big banks. So it's pretty interesting that he did come out and say that, and that was not very widely reported. Of course, I don't think the powers that be want that to be the narrative. They don't want that to be widely known that he said that. But of course, we know that these banks are insolvent. It's only a few select banks that are going to be kept on endless life support. So we're likely going to see more failures. It's just a matter of which banks they let fail, which ones they don't, which ones get bought out by the bigger banks. Of course, nobody knows exactly how it's going to play out, but we do know that it's going to happen. And it's just kind of a wait and see at this point. Also, it was revealed recently that there's going to be big changes in the Basel III requirements. Remember, this is the reserve requirement for the banks, also known as capital requirements. The banks, of course, they're pushing against this. The banks feel like they don't have to have any money in deposits, zero money, but they still want to be able to loan out money even with zero in deposits. Now, the deposits are not zero yet, but doesn't take away from the fact that that's what the banks want. The banks want the ability to have zero in deposits and still make out loans. That way, if we see more bank runs, if we see more people pulling their money out of the banks, it won't matter if the banks are still allowed to loan out money. Well, this capital requirement that's going to be implemented, it's going to have big changes in the banking system. Of course, banks are fighting against that. So it looks to me like they're going to cave in. I'm talking about the regulators, the Fed. They're going to be caving into the bank's demands, as far as I can see, based on what Powell said. He didn't get exactly into what's going to happen, but he did say broad changes are likely to be coming to that Basel III, aka the capital requirement for the banks, right? So bottom line, it looks like more life support and more endless lending abilities for the banks, again, looking to keep this economy propped up, to keep the economy operational, especially here in 2024. Will it work? You let me know down below what you think. Will it work or not? All right, folks, let's transition a little bit here. Obviously, the cost of living is outrageous, but there's a component that we can control ourselves. There's lots of other components that we can't control, right? We can't control the money printing. We can't control policies made from the policymakers, but we can control our impulse and impulsive spending, and we can control what we choose to overpay for or not. Take a look at the social media post. This is from Five Guys Burgers. Now, I've talked about Five Guys Burgers, very overpriced burgers, in my opinion. You can argue that it's worth it, that it's not worth it, that it's good, so good, it tastes so good that you can pay whatever, $50, $100 for a burger. Here's a customer complaining. Cheeseburger, $12.49. Soda, $2.89. French fries, a little French fry, $5.19 total, 20 something dollars after tax, $21.91. Thank goodness he doesn't have to leave a tip because it's a fast food place. My point is, don't complain about prices if you're willing to give the money away. So you have the right to say no. And until more people start saying no to all these things that are overpriced, like a $12 cheeseburger and $5 fries, until that happens, you're likely not going to see prices come down. Even if they don't print as much money, even if some of the policies are changed, just talking about what you say yes to and say no to with your credit card, handing over cash, whatever it is, with your purchases, with your shopping. And I know there's retail therapy. Some people have to go out and just spend money because it makes them feel good. But this is part of the puzzle, folks. This is part of the picture. If you are not willing to say no and maybe not swipe that credit card, maybe not go into debt, or maybe not just spend money that you have saved on such ridiculous prices, then how are you going to complain, right? So this person obviously was on social media. This receipt that I just showed, bring it up again here. This receipt was posted on social media by someone that was complaining about the price. But guess what? He got a receipt to show. That means he made the purchase. So obviously he's not doing anything to help his concern because he gave the money to the company overcharging, right? So that's all I want to say on that, folks. What do you think about the news, about Powell, about the bank situation? Please let me know down in the comments. How does this end up? Soon, more people will have to say no because they're not going to have the credit on their cards available unless the credit card companies continue to just endlessly raise these ceilings, these credit card limits, which I don't see happening, but you never know what type of shenanigans that the powers that be are going to do to keep this economy rolling and to prevent a slowdown or drop in consumer spending, right? So your guess is as good as mine. Please let me know down below what you think about all this. Please make sure you are subscribed. Help us keep this channel alive. Thank you so much. Love to everybody here. Hope you're well. I'll talk to you very soon. Come back for more updates on the economy, financial news, and more. Peace.